What will be moving and shaking the markets next week? Well, joining me now is market analyst Brenda Kelly from CMC Markets in London. Hi Brenda, welcome to DukascopyTV. So to start, in brief, what should currency traders be focusing their attention on next week?
The main things of note will be the GDP figures coming out of UK and the US. We'll also have some German business climate indicators coming out, which generally speaking do tend to move the markets. We've seen GDP product, increase in Germany significantly recently, but the IFO Business Climate Index does tend to show that German economy is facing a downturn, so that could ultimately feed into the euro as a currency.
In terms of weak fundamentals, as you said, the UK has GDP growth figures coming out shortly, of which most are expecting to see a slowdown. However, the head of the French central bank has expressed strongly how he believes if there were to be a country stripped of its AAA status, it should be Britain before France. What's your view on the matter?
I think it makes very little difference. I think at the moment the AAA status, double A status will become the new AAA. To be honest with you, it doesn't really matter in what order this takes place. Ultimately, I think you could expect the UK and France to be downgraded. As to which comes first, it makes very little difference, to be honest with you.
In the latest Federal Reserve meeting, they signalled the possibility of further policy easing next year. Recently, US economic numbers have been improving. So, what growth figures will you be expecting to see when US GDP data is released next week? And of course, what is your current outlook on the US economy?
Okay, well, I would expect, given the GDP figures, to remain fairly the same as what we've seen this year. No real changes there. Ultimately, we could see a slight improvement in the GDP maybe next year, maybe to grow by about 2.6%. But really, the stubbornly high unemployment rates will generally tend to lead to low inflation and interest rates. So unless the policymakers actually act, they could actually shave 1.7 percentage points from the real GDP growth next year. So that will ultimately feed into a better US economy, but it will depend on the policy decisions coming out of Europe and Washington.
What about Japan? Japan's largest manufacturer has revealed a pessimistic outlook for the economy this week. Are you expecting anything major from the Bank of Japan rate decision next week, considering a strong yen and talk of another potential intervention?
Well, we had the Bank of Japan Tankan quarterly survey released last Thursday, and that showed a major decline in the last two quarters, and it was slightly larger than the average forecast, a slide of -2 from +2. So when it met last month, the central bank's policy board said in a statement that the Japanese economy had continued picking up, but at a more moderate rate, and that again will be due to the slowdown in overseas economies. And they downwardly revised its previous assessment presented in October. So we will see them meet next week, and they will discuss whether they should further ease their monetary policy to boost the economy. So in November, we saw the board voting unanimously to keep the key short-term interest rate around 0 to 0.1%, while maintaining its 20 trillion yen asset purchase fund and its 35 trillion yen low-rate fund provision for commercial lenders. But you would see that the flooding, say for instance in Thailand, the prolonged depreciation of the yen, have negatively affected the business sentiment of manufacturers. So you would expect that, given this stronger yen, which has advanced to these record high levels against the US dollar, it being a sort of safe haven play in currencies, has been weighing on the earnings of the major manufacturers. And as long as the global downturn persists, we should still see that flow going into the actual Japanese yen. So you could expect to see some sort of change in policy from the Bank of Japan next week, but it does remain to be seen how they can do it, because ultimately their intervention doesn't seem to be very successful over the last while.
So our focus continues to remain on the developments out of the European debt crisis. I mean, we're only a week on from last week's EU debt deal, and already we're starting to see cracks appear, and market sentiment suggests traders and investors remain unconvinced by the ability of European leaders to solve the crisis. The fiscal pact agreed upon was clearly a stepping stone in the right direction, but why is it not convincing the markets?
I think generally speaking it didn't have the big bazooka effect that markets were expecting. The EFSF fund still remains quite stubbornly low. It is not sufficient to cover the issues of the outstanding debt. So we've seen the likes of Italy come in with very high yields on their bonds. Spain is looking that little bit safer than Italy at the moment. But really and truly, we haven't seen any real decisions or proper implementations coming out of the European leaders to actually help with the crisis. So it does does tend to make you believe that maybe next year we could see a little bit more than just cracks appearing in it, as the contractions continue, as the arguments continue over tax harmonisation, over fiscal compact. It has to be agreed by all of these different countries, and it's hard to see if that will actually take place. So next year will be important. I think the next summit will be in February, but it won't necessarily end right there. I think this could go on for a long time to come.
Thank you very much, Brenda, for your insight on what traders should be keeping an eye on next week. For more market news and interviews, join us again on Monday on DukascopyTV. Goodbye for now.